All right, so we're diving deep today, and this time it's all about how to think about investing, like really getting into the philosophies that build real wealth.
Yeah, it's fascinating stuff.
And this is based on like a whole bunch of sources that you personally selected, right?
Exactly.
So our mission here is to like extract the core principles, the real gems from all of this material.
Absolutely. And especially to uh, kind of decode the mindset of those who actually achieve significant financial success.
Right, because it's not just about like tips and tricks, right? It's about a way of thinking.
Exactly. And that's something that jumps out from what you've shared, this idea that real success in finance, it really demands a way of thinking and acting that, well, it goes beyond what most people do. It's about not being average.
Not being average. Love
Yeah.
it. And that brings us to this concept called the 90-10 rule of money.
Right.
Maybe you've heard of the 80-20 rule, the Pareto principle, like
Yeah.
80% of your results come from 20% of your efforts.
Yeah.
Well, one of the books you chose takes that idea and applies it to wealth. And it gets even more extreme. They're saying it's often the case that 10% of the people end up holding 90% of the money.
It's pretty striking when you think about it.
It is. So what's really interesting is how this 90-10 distribution seems to pop up everywhere.
It does, doesn't it? I mean, look at entertainment. You have a handful of actors who are making most of the money. Same with top athletes or successful musicians.
Yeah, and it's not just anecdotal, there's data to back this up. One of the sources you provided actually mentioned a Wall Street Journal article, and it said that a whopping 90% of all the shares in American corporations are owned by, guess what, just 10% of the population.
Wow.
Right. So the book we're exploring, it wants to shed light on how that top 10%, especially the self-made millionaires, how did they get there? And the implication is these principles, they're not like magic, they're learnable.
Absolutely. And that leads to a crucial understanding that comes through in the material.
Yeah.
Wealth, it's not just about the dollar amount sitting in your bank account.
Hmm.
It's much more about how you see and interact with the world of money, right?
Right.
It starts with a mindset.
Mindset. That's such a key point.
Mm.
One of the books tells a story actually about the author's rich dad, and he makes a move to buy a big piece of real estate when he's only 12 years old. And get this, he did it without any money of his own.
No way.
Yeah, and that really showed the author just how differently his rich dad thought about money compared to his real dad.
Right.
So the real value here isn't just about like specific techniques, it's about grasping that distinct thinking pattern of rich investors.
Absolutely.
Yeah.
And as we dig into this, it's important to remember, like, one of the books clearly points out investing itself can mean very different things to different people.
Oh, for sure.
Yeah.
The rich dad in these books, he really draws a sharp line between actual investing versus like speculating or even gambling. He's super critical of what he calls the buy, hold, and pray strategy.
Yeah, I heard that one.
Those average investors who buy into the market hoping it goes up and then totally panic and sell when it dips.
Yeah, yeah. The material really emphasizes the true investor as someone who can potentially profit, regardless of whether the market's up or down.
Mm.
They understand going long, betting on the price to rise, but also going short, betting on it to fall.
Right, so they're not just at the mercy of the market.
Exactly. And that's a skill that's often missing for the average investor,
Yeah,
which contributes to why so many people just don't see that significant wealth.
makes sense. Now, you mentioned another resource, the cash flow quadrant book, and it lays out this model, right?
Right.
With 4 sections. E for employee, S for self-employed or small business owner, B for big business owner, and I for investor. And the rich dad was all about investing from the B quadrant. Why was that?
Well, what's really insightful here is the emphasis on how tax laws actually work. The rich dad believed that the tax system, it's not really fair in the sense that it's designed by and for the rich.
Interesting.
Yeah, so his point was, if you want to build real wealth, you need to understand the same tax benefits that those B quadrant business owners use.
So it's about understanding the rules of the game, right?
Exactly. And that ties back to the 90-10 rule.
Yeah.
It's that small percentage who actually grasp these nuances and leverage the tax code, legally, of course, to their advantage.
Legally, for sure. There's a great story in one of these books that really highlights this.
Oh, yeah.
It's about the author, he was a pilot in the military, and he compares his situation to his friend, Mike. After just 8 years, Mike is living in this huge estate with his family, while the author is still, sharing basic living quarters.
Wow, that's quite a contrast.
Right. It really shows how different financial paths, driven by different understandings of money and investing, can lead to dramatically different lives.
Absolutely. And speaking of financial systems, the sources also talk about the role of the SEC, the Securities and Exchange Commission. This is the body that was formed after the 1929 stock market crash.
Right, to protect people.
Yeah, the main goal is to protect the public from, as one source puts it, shady investment schemes and to enforce regulations.
And I think the rich dad in these books, he has kind of a critical take on the SEC, right?
He does, a bit. While he recognizes its purpose of protecting people, he suggests that sometimes these regulations can unintentionally limit access to certain investments.
So it could be a double-edged sword.
Right. It might protect some, but it also might restrict others who are not already in a financially strong position.
Interesting. Now, this leads to something called non-registered securities, sometimes called private placement memorandums.
Right. Those are the kinds of opportunities that wealthy individuals often consider.
Yeah, there's this part where Mike shows the author a massive binder filled with details about this kind of investment. And the initial capital required was pretty steep, something like $35,000 per unit.
That's a lot.
Right. At the time, the author was making like $12,000 a year as a pilot. It just shows the difference in scale we're talking about.
Definitely. And then the sources go on to list all these other types of investments that are usually available to what they call accredited investors and sophisticated investors.
Mm,
You have private placements, where you invest in companies that are not publicly traded,
right.
real estate syndication, which is pooling money to invest in larger projects,
Makes sense.
pre-IPOs, those are opportunities to get in before a company goes public.
Mm-hmm.
Then there's select IPO allocations, some subprime financing deals, mergers and acquisitions, loans to startups, and investing in hedge funds.
Right. So a pretty diverse range of opportunities.
Absolutely.
But the point they make isn't that these are necessarily riskier. It's more about the average investor often not having the financial education, the real-world experience, and critically, the excessive capital to truly navigate these waters.
Right. Excessive capital, meaning money they can afford to lose.
Exactly. And it's interesting because the author says he actually came to agree with the SEC's protective stance over time. He learned from some of his own financial missteps.
Oh, that's interesting. So he's not totally against regulation.
Right.
Now, when it comes to learning about investing, the rich dad had this five-phase approach.
5 phases, yeah.
It wasn't really like steps you take in order, but more like, key areas to focus on.
Okay.
First, are you mentally ready to be an investor?
Mindset again.
Right. Second, what kind of investor do you want to be? Third, how do you build a solid business? Fourth, the strategies of the sophisticated investor. And finally, giving back.
Giving back. Interesting. So these 5 phases, it's not about having all the answers,
Right.
right?
It's more about asking the right questions.
And there's a cool analogy the rich dad uses about learning to ride a bike. He says you can read all about it, but you won't really learn until you get on and try. Make a few mistakes, take some risks, get some guidance along the way. Investing is the same.
Hands-on learning. I like that. And speaking of learning, the author talks about how he was exposed to the business world, not through school, but by sitting in on his rich dad's business meetings from like age 9 to 18.
Wow, that's early.
Yeah, he'd listen to bankers, accountants, lawyers, real estate brokers, just absorbing it all.
That's a pretty unique education.
It is. It's a stark contrast to the advice he got from his poor dad, which was more traditional. Good grades, secure job, benefits,
The standard path.
Right, leading towards that E quadrant in the cash flow model.
Right.
Well, the rich dad was all about building businesses and investing through those businesses, B and I quadrants.
And this cash flow quadrant, it really reflects these fundamental differences, right?
It does. Like the need for security, a steady paycheck, often leads people to that E quadrant.
Right, makes sense. There's this pivotal moment in one of the books where the author is thinking about being an airline pilot. Seems secure, good pay, right?
Yeah.
But he remembers the rich dad's lessons about investing and owning businesses. And he realizes a job might get you to accredited investor status, but that's not the whole picture.
That's not the end goal.
Right. Now, they talk about the 3 fundamental reasons or choices for investing. What are those?
Well, they are. To be secure, to be comfortable, or to be rich.
And how do those usually play out?
Typically, it's security first, then comfort, then maybe being rich.
Makes sense.
And that really shapes your job choices, your investment choices.
Right. And when it comes to how people invest, there are all these different approaches, right?
Absolutely. You can invest in yourself, your education, your skills.
Makes you more valuable.
Exactly. Or you can invest in external assets, like stocks. It's mentioned that about 45% of Americans own stocks.
Mm.
And then there's this whole list of investment products: stocks, bonds, mutual funds, all kinds of real estate, single-family homes, commercial properties, land.
Right. A lot of variety.
Yeah. And then there's insurance, commodities, savings accounts, collectibles, precious metals, even hedge funds.
So many options.
And people who invest, they're often categorized by, like, their methods and their favorite assets.
Makes sense.
So you have stock traders, real estate speculators, coin collectors, day traders, people who just save.
Right.
But here's the thing. A lot of people who call themselves investors, they're actually gamblers, speculators, traders, savers, you know.
Just using different labels.
Yeah. And that adds to the confusion.
Right, because investing means different things to different people.
Exactly.
Mm.
And because there are so many products and strategies, no one can be an expert in everything. Everyone has their own biases.
Right. It's good to be aware of that. There's this funny story about the author getting a call from someone wanting advice. Yeah, and they're like, should I invest in stocks or real estate? And the author's thinking, wait, you don't even have a financial plan yet?
You got to start with the basics.
Exactly.
The book really stresses having a solid financial plan before you even think about specific investments.
A roadmap. Right.
Yeah, it talks about investment vehicles and the danger of getting too attached to one, like only stocks or only real estate.
Focus on the bigger picture.
Exactly.
Now, this next part is really interesting. They talk about the power of words and how they shape your financial reality.
Interesting.
There's this quote that stuck with me. If you want to see a person's past, present, and future, just listen to his or her words.
I like that.
And the rich dad was really against that, saying, it takes money to make money. He thought that was a bad idea, especially for building wealth.
Yeah, that can be limiting.
Right. He actually gave the author an assignment to listen to his poor dad's vocabulary during dinner.
Ooh.
Yeah, and the contrast was pretty stark. The rich dad used terms like capitalization rates and leverage, business terms.
That makes sense.
While the poor dad, a teacher, talked about test scores and grants, different worlds.
Totally.
And the rich dad's takeaway was, it doesn't take money to make money, it takes words. He believed your vocabulary shapes your financial reality.
So expand your financial vocabulary.
Exactly.
Makes sense. The books also touch on the need for financial education in schools, to help people become financially secure in the long run.
Right, because without that, there could be some serious consequences down the line.
Exactly. There's a quote, first, ask yourself if you are planning to be rich or if you are planning to be poor. And the rich dad also said that when people often don't realize what it's like to be old and maybe not have enough money.
Yeah, it's easy to overlook those long-term implications.
Absolutely.
Now, there's this mental attitude quiz in the material.
A quiz, okay.
It asks you some pretty direct questions, like, are you planning to be rich, or are you planning to be poor, or are you willing to pay attention to your thoughts?
So it's about self-reflection.
Yeah, and another question is about how willing you are to spend time learning new financial terms. Even just one new word a week can make a difference.
One word a week, that's manageable.
Right. The point is, what we tell ourselves, those inner thoughts, often have more power than what we say out loud.
Absolutely. Now, for those who think investing is too difficult or risky, the material suggests a book by James P. O'Shaughnessy.
Okay, what's it about?
Well, it apparently shows that a simple, passive investing system can actually beat the pros. And it explains why most investors don't make money.
So it's not about being a genius stock picker.
Right.
The sources strongly recommend talking to a financial advisor to create a plan. And they even say to get multiple opinions.
Like getting a second opinion from a doctor.
Exactly.
And it's important to remember, financial advisors sell products, including insurance.
Yeah.
Which is super important, especially when you're starting out with maybe not a lot of money.
Provides a safety net.
Exactly. But as your situation changes, the type of insurance you need might change too.
So the financial plan isn't something you do once and forget about.
Right. It's a living document. You revise it as you learn more and as your life changes.
Makes sense. They recommend interviewing a few different advisors to find one who fits your style.
Right. Find the right fit.
The author says having a financial plan done was a real eye-opener for him.
I bet. It's important to set realistic goals too. The author talks about setting a goal to become a multimillionaire in 5 years.
That's a good goal.
Ambitious, but achievable?
Right. And they also emphasize that making mistakes is part of the process. You learn from them.
Absolutely. Mistakes are valuable.
Now, this leads to the idea that investing, especially as you get more sophisticated, is a team sport
I like that analogy.
because you're not alone.
Right.
The books talk about how many people face financial challenges all by themselves.
Yeah, it can be isolating.
So it's about building a team of trusted advisors, accountants, lawyers, bankers.
Right, a whole team. And financial intelligence means knowing when to go solo and when to call in the experts.
Knowing your strengths and weaknesses.
Exactly. The author actually shares a story about losing money after becoming a millionaire in his 30s, and he says it made him a better businessman and investor.
So setbacks can be valuable too.
Absolutely. The rich dad had this interesting view on investment outcomes. He said out of 10 investments, 3 would be home runs, 5 would do nothing much, and 2 would be disasters.
3, 5, 2. I like that.
Yeah. And he said you learn the most from the disasters.
Ones where you really mess up.
Exactly. It's where the real learning happens.
Makes sense. Now, there's a discussion about how people often prioritize financial goals. Security first, comfort second, and being rich last.
Right, the traditional order.
And they suggest that overemphasizing security can actually hold you back from bigger opportunities. They even critique that live below your means mentality if it stops you from growing financially.
It's about finding the right balance. You don't want to be reckless, but you also don't want to be too afraid to take calculated risks.
Right. And they contrast this with the dangers of spending impulsively without a plan.
Spending without a purpose.
Exactly. The author talks about struggling to communicate with his poor dad about money.
Oh, why was that?
Well, their core values were just different. His dad valued security above all else.
And the rich dad was about building wealth.
Exactly. And the author realized it was more important to respect his dad's choices and focus on his own path.
Respecting differences.
Right.
They also make an interesting observation about people with less money, often holding onto it more tightly, sometimes out of fear.
Makes sense. It's precious to them.
Yeah. And this can even happen to people who have become wealthy, but they still think from a scarcity mindset.
Right. Their mindset hasn't caught up to their wealth.
Exactly. Now, one thing they make really clear is there's no such thing as risk-free investing.
Always some risk.
Yep. There are lower risk options, but never no risk.
So how should people approach risk?
Be honest about your comfort level with it, but don't let fear totally control you. The more secure investments usually take longer to grow, if they grow at all.
Patience is key.
Absolutely.
Yeah.
And like they say, there's no free lunch. Everything has a price in the investment world, whether it's time or money.
Right. There are more questions in that mental attitude quiz we talked about.
No, right, the quiz.
Yeah, like, are you ready to take control of your financial life? And are you willing to put in the time to learn and become a successful insider investor?
Taking charge of your future.
Exactly. And then they ask, on which side of the table do you want to sit? Referring back to the cash flow quadrant.
Right.
The poor dad said, work hard and save money, but the rich dad said, sure, those things are important, but that's how you stay on this side of the table, pointing to the E&S quadrant.
So working hard and saving doesn't automatically make you wealthy.
Right. They point out that a lot of people focus on just one quadrant, based on their childhood dreams, like being a doctor or a teacher.
It's how we're often conditioned.
Yeah, but they argue the most important quadrant to master is the I, the investor, because that's where real freedom comes from.
Freedom and control.
Right. And they compare the author, who is focused on getting a job with benefits, to his friend Mike, who already had a $200,000 investment portfolio by age 15.
That's impressive.
Mike knew how to be an investor before he even finished high school. And the point is, in today's world, you need that financial sophistication. You need to understand assets versus liabilities.
Definitely.
Yeah.
And build a financial portfolio that goes beyond just your house.
Exactly. Now, this next part is fascinating. The rich dad would actually seek out investors who are complaining about losing money.
Why would he do that?
Not to gloat or anything, but to understand their mistakes and see if any opportunities arose from their situation.
So he was looking for bargains.
Yeah, he called it looking for the skipper of the Titanic.
Interesting analogy.
He wasn't interested in those stories about quick wins in the market. He saw that as a fool's game.
Right.
He wanted to hear tales of woe and misery, because that's where the real value often hides.
Where you can find assets undervalued, maybe.
Exactly. Especially for those operating in the B&I quadrants, they can take those liabilities and turn them into assets or wait for someone else to do it.
So it's about seeing opportunity where others see only problems.
Right. And they talk about how all this negativity, these doom and gloom predictions, can blind people to real opportunities.
Yeah, like being afraid to invest in real estate because you don't want to deal with repairs.
Exactly. The solution is to hire a property manager, right? Let someone else handle the day-to-day.
You still get the benefits of ownership without the headaches.
Exactly. The key is to be prepared to seize those opportunities when they arise.
Absolutely. Now, they talk about the three E's that are essential for investing at the rich level. Have you heard of these?
I'm intrigued. Lay it on me.
Okay, so it's education, experience, and something called excessive cash.
Excessive cash, what does that mean?
It means having enough money that you can afford to lose on an investment and still learn from it and come out ahead in the long run.
Okay, so it's about having a cushion.
Right. They emphasize that low risk, high return investing, it takes a lot of study, especially learning about business fundamentals.
Makes sense.
To be a rich investor, particularly in the stock market, you need to understand what makes a business successful. You need those B quadrant skills. And most people are trained to be employees or self-employed, so they don't have that.
It's a different way of thinking.
It is. And they introduced this principle called Gresham's Law, which is bad money will always drive out good money.
Okay, what does that mean in this context?
Well, it means that the value of money tends to go down over time, right?
Mm,
Inflation and all that.
right.
So you need to acquire assets, good money, that hold their value or go up in value, and that can produce more of that bad money, the devalued currency.
So it's about creating a cycle where your assets generate more money.
Exactly. That's why they say the rich don't work for money. They work to acquire assets that produce money.
It's a shift in perspective. They link the fear of investing to a lack of financial literacy, specifically the ability to read financial statements.
Right. That's crucial.
That's why the rich dad started teaching the author about financial statements at such a young age.
He was giving him the tools to understand the language of money.
Exactly. And it's about seeing the difference between looking for a job and looking for opportunities.
Earning income versus generating passive or portfolio income.
Right. And most people leave school without ever learning how to balance a checkbook or read a financial statement.
It's a real gap in education.
They make a point that every business, every stock, every piece of real estate, even every person has a financial statement, whether they realize it or not.
It's like a hidden language.
And those who don't understand that language, they're often the ones with the least money and the most problems.
The ones who are most at risk.
Exactly. They even criticize the idea of losing money on purpose for tax breaks.
Yeah, that doesn't seem like a good strategy.
Right. They say a real investor focuses on making money first and sees tax benefits as a bonus.
So don't celebrate a tax write-off from a losing investment.
Exactly. The rich dad made the author create his own personal financial statements and analyze those of businesses and real estate.
He was teaching him to think like an investor.
Right, to see the financial story behind everything. They compare financial statements to report cards, but for after you leave school.
Interesting analogy.
Because someone can have a great job, a nice house, but their personal financial statement might be failing.
Right, appearances can be deceiving.
The rich dad wanted to achieve financial independence by 45.
That's a good target.
It is, and it emphasizes the importance of time,
Yeah.
It's a finite resource.
Absolutely, time is precious.
The big takeaway here is that understanding financial statements helps reduce risk in investing. And gaining control of your personal financial statement is crucial before you start making bigger investments.
It's about taking responsibility for your financial well-being.
Exactly. And they warn against investing just to pay off debt.
Right. You need a clear purpose.
A true investor aims to acquire assets that turn earned income into passive or portfolio income.
That's the goal. Now, they have this section called Rich Dad's Basics of Financial Literacy, and they start with defining assets and liabilities.
Okay, how do they define those?
An asset puts money in your pocket. A liability takes money out of your pocket. Simple, but powerful.
Makes sense.
And they challenge the assumption that a house is always an asset.
Right, because it depends on the cash flow.
Exactly. They use the example of a rental property. If the expenses, like mortgage payments and repairs, are more than the rent, it's actually a liability.
It's taking money out of your pocket instead of putting it in.
Right. And they warn against counting your chickens before they hatch when it comes to hoping for future price appreciation.
Don't rely on something that might not happen.
Exactly.
They also talk about how the 1986 Tax Reform Act impacted real estate.
Oh, yeah. What happened there?
Well, it removed a lot of the tax breaks that real estate investors had been relying on.
So it changed the game for them.
Big time. It led to billions in losses for speculators who were focused on those tax breaks instead of the actual cash flow.
Wow.
And it triggered a chain reaction, a stock market crash, savings and loan failures, and a huge wealth transfer from the S quadrant to the I quadrant.
Those who understood how to invest wisely came out ahead.
Exactly. And they ask if something similar might happen again, maybe with paper assets this time.
It's an interesting question to ponder.
Right. They keep emphasizing why invest in something that's likely to lose money? Find investments that generate positive cash flow.
Focus on the fundamentals.
Exactly. And they really push back against that. It's okay to lose money because of tax breaks logic.
They want you to think bigger.
Right. Invest in a way that gives you security, income, appreciation, and tax advantages.
The whole package.
Exactly. They address that count your chickens before they hatch mentality again.
Right. The idea that future appreciation will make everything okay.
Yeah, those investors who see liabilities like their own house as assets based on like future hopes and dreams.
Hopes and dreams don't pay the bills.
They don't. They say focus on what you can control today, your financial education, your cash flow.
Makes sense.
Yeah.
They even ask, if you're so sure the price is going up, why not buy 10 of those houses?
Calling their bluff.
Exactly. They mentioned this program called Your First Step to Financial Freedom that teaches people how to manage money like the rich do.
Okay, what's the focus there?
It's about understanding that making more money isn't enough. You have to know how to manage it, invest it, and make it work for you.
Right, it's not just about income, it's about what you do with it.
Exactly. They use the example of savings to illustrate how something can be an asset for one person and a liability for another.
Okay, I'm curious, how does that work?
Well, your savings in the bank are an asset for you, but for the bank, it's a liability because they owe you that money.
Ah, I see. Two sides of the same coin.
Exactly. You need to understand both perspectives.
It's like looking at the whole financial picture.
Exactly.
They also talk about how some things you can be taught and some things you have to learn through experience.
Like riding a bike.
Exactly.
You can read all about it, but until you actually try, you won't really learn.
Hands-on experience.
Right. And that's where the cash flow games come in.
The games,
They
yeah.
let you practice investing in a safe environment. Host speaker.